Yep, the dream. It's over. Bitcoin is dead again for the 462nd time. Look, I know what you're feeling right now. I can see it in the comments. I can feel it in the DMs. I can sense the panic spreading across Twitter, YouTube, and Reddit. People are scared. People are selling. People are convinced this is the end. And I get it. I really do. Bitcoin is at $63,487 right now. It touched near $62,000 earlier today, down nearly 50% from the all-time high. The Fear and Greed Index is at 12. Extreme fear. 2.5 billion in liquidations. ETF outflows. Media declaring victory. It looks bad. It feels bad. The charts are ugly. But before you panic, before you sell, before you make a decision, you might regret. Let me show you something I found this morning. I was doing research, looking at on-chain data, checking institutional flows, reading analyst reports, and then I stumbled across a website called bitcoindeaths.com. Now, here's the part that made me laugh, the ironic, almost comedic part. This website exists for one purpose, to document every single time Bitcoin has been declared dead by media, experts, critics, and financial institutions. And you know how many times that's happened? 461 times. 461 documented obituaries since 2010. But here's where it gets really interesting. The website has a chart, a beautiful chart showing Bitcoin's price over time, with all 461 death predictions marked on it. And at the bottom of the page, there's a sentence that stopped me in my tracks. Bitcoin has been declared dead 461 times. If you invested $100 each time, you'd have 66, 332, 43 today. Let me repeat that. If you had invested just $100 every single time an expert declared Bitcoin dead, you'd have $66,332,000 today. Not from timing the top, not from being a genius trader, not from leverage or derivatives, just from buying when everyone else was panicking, just from investing at the moments of maximum fear, just from doing the opposite of what the headlines were screaming. So before we dive into the data, I want you to take a deep breath. I want you to calm down. I want you to understand something critical. You are not the first person to feel this fear. This exact moment has happened 461 times before. And every single time the people who panicked lost money. And every single time the people who stayed calm made money. So let's be calm. Let's look at the data. Let's separate emotion from reality. Hit that like button. Subscribe if you haven't. Turn on notifications. Drop a comment right now. Capitulation or accumulation? Let's see where you stand. Here's what's happening right now. Bitcoin is at $63,487. That's the lowest level since November 2024 from the October 2025 peak of $126,000. We're now down 49.6%, nearly half. And yes, the internet is having a complete meltdown. Twitter is filled with "I told you Bitcoin was a scam" posts. YouTube is flooded with "why I'm selling everything" videos. CNBC has rolled out every Bitcoin critic from the last decade to declare victory. The headlines read, "Crypto winter has arrived. Bitcoin bubble finally pops. The end of digital gold." But here's what Bitcoins.com showed me. This exact script has been performed 461 times since 2010. Same panic, same headlines, same declarations. And every single time, Bitcoin came back. Because price crashes don't change fundamentals. They only change perception. And perception is temporary. Let me show you some of my favorite Bitcoin deaths from that website. November 15th, 2011. Bitcoin was at $2.33. Wired magazine published an article titled "The Rise and Fall of Bitcoin." Quote, Nobel Prize-winning economist Paul Krugman wrote that the currency's tendency to fluctuate has encouraged hoarding. A former eCash consultant calls Bitcoin clever, but believes it's fundamentally structured like a pyramid scheme. Bitcoin was declared dead. Today, Bitcoin is at 63,500. That's 27,250 times higher than when Wired wrote that. Article, December 2013, Bitcoin crashed from $1,000 to $200. Paul Krugman himself wrote another article declaring Bitcoin worthless and predicting its imminent collapse. Today, Bitcoin is at 63,500. January 2018, Bitcoin crashed from 20,000 to 3,200, an 84% collapse. Every major financial publication declared Bitcoin dead. The New York Times, Bloomberg, Wall Street Journal, CNBC, all of them. Bitcoin is finished. Then what happened? Bitcoin went from 3,200 to 69,000 by November 2021. That's a 256% gain from its obituary. November 2022, Bitcoin crashed from 69,000 to 15,500, 77% down. FTX had just collapsed. Terra Luna had imploded. Celsius had frozen withdrawals. Three Arrows Capital had gone bankrupt. The entire crypto industry looked like a house of cards falling apart. Every single expert said, "This time it's different. This time Bitcoin won't recover. The fraud has been exposed." Then what happened? Bitcoin went from 15,500 to 126,000 by October 2025. That's an 813% gain from extreme fear. Do you see the pattern? The obituaries always come at the bottom. The declarations of death always come at maximum pain. The experts always call the top perfectly in reverse. Why? Because they're looking at price, not fundamentals. They see a chart going down and assume it means the asset is broken. They never ask the right questions. Is the network still running? Are transactions still processing? Has the technology failed? Has adoption reversed? The answer is always no. The network keeps running. Transactions keep processing. Miners keep mining. And smart money keeps accumulating while everyone else panics. This is not an accident. This is not random. This is by design. These crashes serve a very specific purpose. They transfer Bitcoin from weak hands to strong hands. From people who don't understand it to people who do. From retail panic sellers to institutional patient buyers. From sardines to whales. It's the same transfer mechanism that has repeated every single cycle. Price goes up. Retail FOMOs in at the top. Price crashes. Retail panic sells at the bottom. Whales accumulate. Repeat. And right now we're in the accumulation phase. The phase where retail is convinced it's over. The phase where whales are quietly filling their bags. The phase where fortunes are made by people with conviction and patience. Now, before I show you the institutional data, let me be extremely clear about something. This is not financial advice. I'm not telling you to buy. I'm not telling you to sell. I'm showing you historical patterns, on-chain data, and market cycles. What you do with that information is your responsibility. And whatever you decide, make absolutely sure you're only using money you can afford to lose. Money that won't affect your rent, your bills, your life. Money you won't need to touch for years. Because if you're investing money you actually need, then you should be scared. And you should reduce your position immediately to a level where you can sleep at night. Understanding this distinction is critical. There's a massive difference between being a disciplined investor with proper position sizing and being an over-leveraged gambler hoping for a bailout. One survives bear markets, the other gets destroyed by them. Now, let's talk about what makes this moment unique. Because while the pattern is familiar, the context is completely different from any previous cycle. The S&P 500 is near all-time highs, around 7,000 points. Stocks are at record levels. Corporate earnings are strong. The U.S. economy is expanding. Manufacturing PMI just crossed above 50 for the first time in 12 months. Meanwhile, Bitcoin is at 67,500, down 46.5%. At 15-month lows, completely diverging from risk assets. What's happening? This is a liquidity rotation event. Capital is flowing out of speculative assets like Bitcoin and into established assets like U.S. equities. Why? Fear. Fear about Kevin Warsh becoming Fed chair. Fear about interest rates staying higher. Fear about reduced global liquidity. Fear about tighter monetary policy. So investors are de-risking, moving from Bitcoin to stocks, from high volatility to moderate volatility, from uncertainty to perceived safety. But here's the critical insight. These divergences are temporary. They're market inefficiencies, they're opportunities disguised as risk. Let me show you what happens historically when Bitcoin and stocks diverge like this. March 2020, COVID crash. Stocks crashed, then recovered within months. Bitcoin lagged, consolidating around $10,000 while the S&P made new highs. Everyone said Bitcoin is no longer a risk asset. It's dead money. Move to stocks. Then what happened? Bitcoin went from 10,000 to 69,000 in 18 months, 590%, while stocks went up 100%. July 2016, Brexit. Markets were volatile. Stocks were choppy but trending up. Bitcoin was stuck at $600 for months. Everyone said Bitcoin is irrelevant. The institutional money has moved on. Then what happened? Bitcoin went from 600 to 20,000 in 18 months, 3,300%, while stocks went up 25%. The pattern is consistent. Bitcoin underperforms during fear. Then Bitcoin massively outperforms during recovery. Not by a little, by multiples. Why? Because Bitcoin is a leveraged bet on global liquidity and risk appetite. When risk appetite returns, when liquidity flows back into speculative assets, Bitcoin doesn't just catch up. It overshoots violently. And right now, we're in the underperformance phase. The phase where everyone abandons Bitcoin for safer assets. The phase right before the explosive catch-up. Make sure you're subscribed with notifications on. And comment, are you waiting for safety or buying the fear? Now, I need to address the elephant in the room. Institutional money. You're probably thinking, But institutions are leaving Bitcoin. ETFs had 1.6 billion in outflows last week. That's bearish, is it? Let me tell you what's really happening. When Bitcoin was at 126,000, were institutions buying? No, they were sitting on the sidelines. When Bitcoin was at 110,000, minimal buying at 95,000, some outflows. But at 70,000, at 67,000, that's when they start positioning quietly, without headlines, without fanfare. Here's what you need to understand about institutional capital. They don't buy tops. They don't chase momentum. They wait for capitulation. They wait for retail to give up. Then they accumulate. And right now, retail is giving up. The fear and greed index is at 12. 12, that's extreme fear. That's capitulation territory. That's where institutions build positions. Let me show you what institutions are actually doing right now. While you're reading headlines about Bitcoin being dead, here's what's happening behind the scenes. MicroStrategy. As of February 2nd, 2026, they hold $713.52 Bitcoin. That's 54.26 billion invested at an average price of $76.52 per coin. Bitcoin is at 63,500 right now. That means MicroStrategy is showing a paper loss of about 16.5%. And what did they do last week? They bought more Bitcoin, 855 Bitcoin for $75 million, funded by selling more stock. Think about that. Michael Saylor's company has been accumulating Bitcoin for over 5 years. They're the largest corporate holder of Bitcoin in the world. They hold 3.4% of all Bitcoin that will ever exist. And at the exact moment when retail is panic selling, when the fear and greed index is at 12, when everyone is screaming it's over, when they're sitting on a paper loss, they're still buying. Does that sound like a company betting on a dying asset? Or does that sound like a company with unshakable conviction in the long-term thesis? Now, let's talk about BlackRock, the largest asset manager in the world, $12.5 trillion under management. Their Bitcoin ETF, IBAT, launched in January 2024. In just 2 years, it became the largest Bitcoin ETF in existence. How much Bitcoin does BlackRock exhibit hold? 784,000 Bitcoin, around $70 billion in assets. Under management, fluctuating with Bitcoin's price. And 3 weeks ago, in late January 2026, what did BlackRock do? They filed to launch a second Bitcoin product, the iShares Bitcoin Premium Income ETF. Let me repeat that. Bitcoin dropped from 126,000 to 63,500, down 49.6%. 6%, nearly half extreme fear in the market, retail, capitulating media writing obituaries, and BlackRock's response, double down, launch another Bitcoin product. Does that make any sense? If Bitcoin is truly dead, would the world's largest asset manager be expanding their Bitcoin product line? If they thought the asset had no future, would they be investing millions in infrastructure custodianship through Coinbase legal compliance? Marketing all for a dead asset? No, they wouldn't, because here's the thing. People don't understand about institutions. They don't make emotional decisions. They don't panic. They don't read Twitter and change their entire investment thesis. They have teams of analysts, quantitative researchers, risk managers, legal experts, compliance officers. They run scenarios. They model long-term adoption curves. They analyze network effects and supply dynamics. And every major institution that has studied Bitcoin deeply has come to the same conclusion: long-term structural value. Now, let's zoom out even further. U.S. Bitcoin ETFs collectively hold 1.3 million Bitcoin. That's about 6% of the total supply that will ever exist. Think about that. Institutional products launched just 2 years ago now control 6% of Bitcoin's total supply. And you think Bitcoin is dead? Here's more. Bank of America, with $3.5 trillion in assets under management, now recommends Bitcoin ETFs to clients. Vanguard, which famously refused to offer Bitcoin products for years, reversed course in 2025. They now offer Bitcoin exposure to 8 million clients. Wells Fargo opened Bitcoin ETF distribution. Morgan Stanley just filed registration to launch their own spot Bitcoin ETF. Does this look like a dying asset to you? Or does it look like the early stages of mainstream institutional adoption? I know what you're thinking. But John, the ETFs had 1.6 billion in outflows last week. That's bearish, is it? ETF flows are noisy. They fluctuate daily, week to week, month to month. But since launch, Bitcoin ETFs have attracted 56 billion in cumulative net inflows. 56 billion, and they still hold around 100 to 117 billion in total assets, fluctuating with Bitcoin's price. So yes, there are outflows during fear, but the long-term trajectory is clear. Capital is flowing into Bitcoin through institutional channels, not out. Here's the logic that should be painfully obvious. BlackRock doesn't create ETFs for assets they think will go to zero. MicroStrategy doesn't accumulate 713,000 Bitcoin if they think it's worthless. Banks don't recommend allocation to dying assets. These are sophisticated, risk-averse institutions with fiduciary responsibilities. If Bitcoin was truly dead, they'd be winding down, cutting losses, moving on. But they're doing the opposite. They're doubling down, expanding product lines, building infrastructure because they see what short-term retail traders don't. Bitcoin is not dead at 63,000. Bitcoin is on sale at 63,000. Hit that like button if this institutional logic makes sense. And drop a comment. Institutions are buying or institutions are selling. Now, let's talk about fear and greed, because this is where it gets really interesting. The Crypto Fear and Greed Index measures market sentiment on a scale from 0 to 100. 0 is extreme fear. 100 is extreme greed. Right now, we're at 12. Extreme fear. What does that mean? It means the market is in full panic mode. Retail is capitulating. Emotions are driving decisions. Logic has completely left the building. But here's the fascinating part. Extreme fear is historically a buy signal, not a sell signal. Let me show you the data. November 2022, fear and greed. Index hit 10. Extreme fear. Bitcoin was at 15,500. Everyone was convinced it was going to zero. FTX had collapsed. Luna had imploded. The entire industry looked like a fraud. Then what happened? Bitcoin rallied to 126,000 over the next 34 months. That's an 813% gain from extreme fear. March 2020, fear and greed. Index hit 8. Bitcoin was at $3,800. The world was shutting down. Co-panic was everywhere. People thought the financial system was collapsing. Then what happened? Bitcoin went to 69,000 in 21 months. That's an 16% gain from extreme fear. December 2018, fear and greed index hit 10. Bitcoin was at 3,200. The bear market had lasted 12 months. Everyone had given up. Crypto was declared dead by every major publication. Then what happened? Bitcoin went to 69,000 in 35 months. That's a 256% gain from extreme fear. Do you see the pattern? Extreme fear marks bottoms. Not always perfectly, not always immediately, but historically, when the index hits extreme fear, we're much closer to a bottom than a top. And right now, we're at 12, close to extreme fear levels of previous cycle bottoms. Does that mean Bitcoin can't go lower? Absolutely not. We could test 65,000, maybe 60,000, maybe even 55,000. Markets overshoot. Emotions drive prices beyond rational levels. But probability based on historical data suggests we're in the late stages of capitulation, not the early stages. Quick check. Are you still here? Good. Hit that like button again. Make sure you're subscribed and drop a comment with your Bitcoin average purchase price. Let's see where everyone's positioned. No judgment, just data. Now, let's talk about leverage because this is the most important part of this entire video. Last week, $2.5 billion in leveraged crypto positions were liquidated. $2.5 billion. In just a few days, let that sink in. $2.5 billion of borrowed money wiped out. These weren't sophisticated investors. These weren't patient long-term holders. These were gamblers using leverage, betting Bitcoin would only go up and getting completely destroyed when it went down. When Bitcoin falls fast, exchanges automatically close leverage positions to protect against further losses. This creates a cascade effect. Forced selling pushes prices lower. Lower prices trigger more liquidations. More liquidations create more selling. It's a death spiral. But here's the key insight. Every Bitcoin that gets liquidated gets bought by someone. And that someone, it's usually someone with cash, someone without leverage, someone patient. This is the transfer mechanism. This is how Bitcoin moves from weak hands to strong hands. From people gambling with borrowed money to people investing with their own capital. And right now, we just witnessed one of the largest liquidation events of the entire cycle. $2.5 billion in leverage flushed, gone, cleared from the system. What does that mean? It means the market is cleaner now. Less leverage, less speculation, less gambling, more real holders with real conviction. And that's actually bullish because markets with less leverage are healthier markets. They're more stable. They're less prone to cascading crashes. They're ready to build a foundation for the next leg up. But here's my message to you. Do not be part of the next liquidation event. Do not use leverage. Do not borrow money to buy Bitcoin. Do not invest money you can't afford to lose. Do not gamble with your future because if you do, you will get liquidated. Maybe not today, maybe not tomorrow, but eventually you'll hit a moment like this where Bitcoin drops 46% in 4 months and your entire position gets wiped out at the worst possible time. The only people who survive these crashes are people who own their Bitcoin outright. No leverage, no borrowed money, no margin calls, just patient capital that can weather any storm. If you can't sleep at night because you're worried about Bitcoin's price, you're overexposed. Period. Reduce your position to a level where a 50% drop wouldn't destroy your life because Bitcoin will drop 50%, maybe multiple times. That's the nature of the asset. That's the price you pay for asymmetric upside potential. If you can't handle that volatility without leverage, then you're not investing. You're gambling. And gambling always ends the same way, badly. All right, let's talk about the 4-year cycle because this is where the long-term perspective becomes crystal clear. Bitcoin has a strange, almost eerie pattern. Every 4 years, like clockwork, we see a major peak, followed by a deep correction, followed by recovery to new all-time highs. 2013, peak at $1,150, then crashed 84% to $177, then recovered to new highs by 2017. 2017, peak at $19,800, then crashed 84% to $3,200, then recovered to new highs by 2021. 2021 peak at $69,000, then crashed 77% to $15,500, then recovered to new highs by 2025. 2025 peak at $126,000, currently down 46.5% to around $67,500. Recovery by 2029, notice the pattern. The peaks keep getting higher, but the crashes are getting less severe. 2013, 84% crash. 2017, 84% crash. 2021, 77% crash. What does this tell us? Bitcoin is maturing. The volatility is decreasing. The crashes are moderating. The market is becoming more stable. Why? Because the market structure is changing. In 2013, it was 99% retail speculation. In 2017, maybe 95% retail. In 2021, maybe 70% retail, 30% institutions. No, it's probably 50-50, maybe even 40-60 if you count all the institutional capital that's entered through ETFs and corporate treasuries. As institutional capital increases, volatility decreases, not eliminated, but moderated. Could Bitcoin crash further? Absolutely. We might see 65,000, 60,000, maybe even 55,000 if panic really escalates. But could the 4-year cycle break? Could Bitcoin not recover this time? Yes, it's possible. History doesn't guarantee the future. But for the cycle to break, the fundamentals would need to break. The network would need to fail. The technology would need to be superseded. Adoption would need to reverse. Has any of that happened? Network hash rate at all-time highs. Transaction volume steady. Miner capitulation not happening. Adoption reversal? Nope. BlackRock is expanding Bitcoin products. MicroStrategy is still accumulating. Nation-states are building reserves. Technology failure. The blockchain has produced a block approximately every 10 minutes for over 15 years without interruption. The code works. So if none of the fundamentals have deteriorated, why would the cycle break? Price is perception. Price is psychology. Price is the market's temporary opinion about future value. And opinions change fast. I believe the cycle continues. Not because I'm optimistic, not because I'm a Bitcoin maximalist, but because the engineering hasn't changed, the 21 million supply cap hasn't changed. The decentralization hasn't changed. The censorship resistance hasn't changed. Everything that made Bitcoin valuable at 126,000 still exists at 67,500. Only the perception has changed. And perception always corrects eventually. My base case, one more leg down to 60 to 65,000. Bottom forms in March or April. Recovery begins. Q2, Q3, back above 100,000 by year-end. New all-time highs in 2027. But I could be completely wrong. This is probability, not certainty. Which is why position sizing is everything. Which is why leverage is suicide. Which is why you only invest money you can afford to lose. Hit that like button one more time. Make sure you're subscribed. Turn on all notifications. Alright, let's wrap this up. Bitcoin is at $63,487 right now. From the October 2025 peak of $126,000, we're now down 49.6%, nearly half. Fear and greed index at 12. Extreme fear. 2.5 billion in liquidations. Retail capitulating. Media writing obituaries. This is the 462nd time Bitcoin has been declared dead. But you know what? The network is still running. Transactions are still processing. Miners are still mining. Whales are still accumulating, and the fundamentals haven't changed. Price is temporary. Fundamentals are permanent. Remember that website I showed you at the beginning, bitcoindeaths.com? Remember what it said? If you invested $100 every time Bitcoin was declared dead, you'd have $66,332,000 today. $66,332,000. Not from genius, not from luck, not from insider information, just from buying when everyone else was panicking, just from doing the opposite of the crowd, just from understanding that declarations of death are buying opportunities. So, here's my final question for you. Are you going to believe the 460-second obituary, or are you going to trust the 15-year track record of resilience? Are you going to sell to the whales at 63,000, or are you going to be the whale accumulating while everyone else panics? Are you going to let fear drive your decisions, or are you going to let data guide your strategy? The choice is yours. But remember, generational wealth isn't built buying what feels safe. It's built buying what feels terrifying when the fundamentals say otherwise. Near term, no idea. Bitcoin might go to 62,000, might go to 58,000, might consolidate for months. Nobody knows. Long term, the architecture is intact. The network is secure, the adoption is growing, the fundamentals are solid. So, I'm going to trust the engineering, not the obituaries. Final call to action. If this video gave you perspective, smash that like button right now. If you're not subscribed, subscribe and turn on notifications because this cycle is far from over. And drop one final comment. Selling or accumulating? But wait, if you made it all the way to the end of this video, you're different. You're not here for quick dopamine hits. You're not here for hype. You're here for data, for understanding, for conviction. You're the kind of person who can look at a 46% crash and see opportunity instead of disaster. The kind of person who reads Bitcoin deaths, calm, and thinks $70 million from buying fear. The kind of person who holds when everyone else panics. The kind of person with diamond hands. So, if you watch this entire video, if you stuck around through 22 minutes of analysis, data, and truth, if you understand that Bitcoin has been declared dead 461 times and came back every single time, if you have the conviction to hold through the fear, drop one word in the comments right now. Diamond. Let me see who the real ones are. Let me see who understands that this is the 460-second death. And just like the previous 461 times, Bitcoin will come back because fundamentals don't change. Only perception does, and perception always corrects eventually. See you in the next one.